Ladies and gentlemen, good day, and welcome to the CSB Bank Q1 FY26 earnings conference call hosted by Yes Securities. As a reminder, all participant lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your dashboard phone. Please note that this conference is being recorded. I would now hand the conference over to Mr. Shivaji Tapriya from Yes Securities. Thank you, and over to you, sir.
Thank you, Muskan. Good evening and a warm welcome to all those who have joined the call. The CSB Bank management is represented by Mr. Pralay Mandal, Managing Director and CEO, Mr. B.K. Divakara, Executive Director, and Mr. Satish Gundevar, Chief Financial Officer. We specifically thank the management of CSB Bank for giving Yes Securities the opportunity to host their result call. The management will first be making some opening remarks, after which we will throw the floor open for questions. I now invite the management to make their opening remarks. Pralay, over to you.
Thank you, Shivaji, and thank you everybody for joining the Q1 FY26 call of CSB Bank. I will start with the global scenario and then get into CSB specifics. With the global trade is impacted by uncertainties of U.S. stance on its tariff and other countries. Though USA has announced the new tariff, individual countries are still negotiating, making the outcome uncertain. This uncertainty is getting reflected in currencies, rates, and commodity prices. UK and EU have cut rates while US Fed continues to hold on its rates. With weakening data in the US, it is likely that Fed will cut rates further in the coming months. Global growth forecasts have been revised downward by major forecasts in recent months. India growth has been steady over the quarter. The series of liquidity measures taken and the rate cuts announced by RBI has brought the rates down on assets and liability both. Transmission has been good so far. Liquidity in the banking system has remained in surplus, supporting the financial stability. The inflation forecast has been revised lower. However, the projections for the next year are above 4%. The deposit and credit growth in the system is evenly balanced right now, with deposit growth on the rise and credit growth on the decline as compared to previous year. The pattern has impacted the banking sector NIM significantly. We expect the banking sector NIM to stabilize soon and the liquidity to remain comfortable. RBI may cut rates further in this fiscal year in the wake of uncertain trade negotiations with the US. Now coming to CSB specifics. On financials, the quarter gone by will be recorded as one of the most exciting quarters in our SBS 2030 journey. In view of the challenges it threw, the efforts and dedication we put in what we achieved. I am happy to share that all of us have successfully migrated to the new CBS FlexCube and rolled out 50 plus surround systems with 12 within the CBS system, which makes it to 62 surround systems without losing sight of the balance growth in the bank. It has been extremely exciting quarter for us from a execution of this long-awaited transformation journey on the technology side, and all of us has been very, very busy focusing on this particular aspect this quarter, because based on this only, the future of the bank will be rebooted. Coming to financials specifically, on profitability, net profit for Q1 stood at 119 crores, up by 5% year-on-year. Operating profit of the bank grew by 28% on a YOY basis and stood at 220 crores. Other income registered a robust growth of 42% on a YOY basis and constituted 19% of total income for Q1 FY26. Cost to income ratio was lower at 64.70% as on Q1 FY26 as against 67.69 a year back in Q1 25. Despite the interest rate transmission dynamics between advances and deposits in a falling rate scenario, NIM could be maintained at 3.54. We do not expect NIM to go down further from this level. ROA for the quarter ended 36.25 stood at 1.03%. As we know, our bank has a history of continuing to grow the ROA through the quarters and peaks in the Q4 of year, and this year also we'll see the same trend. Bank is holding the contingency provisions intact and is continuing with the accelerated loan provisioning policy. On the liability side and the funding base, deposit growth momentum continues to be faster than the industry, grew by 20% YOY amidst an industry growth of around 10%. CASA grew by 13% YOY and the CASA ratio stands at 23.49%. We have sufficient liquidity buffers and are maintaining an LCR at comfortable levels. We have been efficiently managing the liquidity risk because in Q4 of last year, when liquidity was significantly negative, the bank took a call to manage the liquidity risk carefully. As that risk is coming down, we now see our CD ratio at around 92%. Average LCR for the quarter has been around 123%. NSFR ratio is around 120%. On the asset side of the business, net advances grew by 31% YOY, again significantly higher than industry growth of close to 10% YOY. All the verticals have started contributing towards asset growth, with gold, corporate, and SME portfolio registering a YOY growth of above 30% at 36, 32, and 31% respectively. Retail loans other than gold grew by 19%, despite a deliberate moderation in agri MFI and other unsecured loans, and we have been doing it for the last 18 to 24 months. Yield on advances for Q1 FY26 is 10.73%. Regarding the asset quality matrices, GNP and NNP ratio for the quarter was at 1.84 and 0.66% respectively, as against 1.69 and 0.68% for Q1 FY25. PCR now stands at 80.46 with PWO and 64.52 without PWO. Bank is holding a provisioning buffer of around 194 crores over and above regulatory requirements. Out of this, around 105 is contingency provision. We have a robust capital base, CRAR of 21.71, Tier 1 ratio of 19.92, low proportion of risk-weighted assets compared to the industry, which is 40%. Shareholder value creation, the book value per share is at 258 rupees right now. EPS for the year is 27.42, ROE for the year is 10.9. Like ROE also progressively grows for us quarter on quarter, peaking in the fourth quarter, and which again this year will be no exception. On distribution, we have a network of 834 branches now and 800 ATMs as on 36/25. In conclusion, I would like to say that our top line, both deposits and advances, has shown strong YOY growth of 20% and 31% respectively. Compared to Q1 FY25, our CASA book grew by 13%. All the three asset verticals with retail, including gold loan, SME, and wholesale banking, grew by more than 30% over Q1 FY25. On the profitability, while our operating profit grew by 28% on a YOY basis, net profit increase was at 5% due to slightly higher slippage and resultant provisions. However, we would recover a decent amount subsequently, and we have already recovered a fair bit already in this quarter, in Q2 I mean, and expect portfolio quality to improve in this quarter itself. If I look back and review the journey we completed in Q1 FY26, I proudly say that the CSB team has done a remarkable job in truly short span of time, duly balancing the tech transformation and growth. We have achieved what we aspired for in building the platform for future. We have built a solid foundation for scaling the bank in terms of business and customer experience as we go along. Given the complexities involved in such a massive project, it will take a couple of months more to fully stabilize everything. Once the systems are stable, we'll kickstart the scale phase with a lot of confidence, as we'll be in a better position to serve our customers by providing innovative customized products, straight-through processes, seamless digital experience, higher operational efficiencies, etc. We'll also be benefited at lower cost points and additional revenue streams. Thus, we'll start the journey of becoming a respectable mid-sized bank by 2030, and hopefully we can execute to reach that mission ahead of our targeted timeline. As I have told in past, that as a part of our SBS vision, our sustain phase and build phase is expected to get over by beginning of FY27, and the real scale phase and the most exciting part of the journey is going to start from FY27 beginning, and FY27, FY28, FY29, FY30, these 4 years will take the bank to a completely different spectrum. I'm happy to report that based on the technology transformation journey we have done successfully, and one of the best which our partners says they have seen, we are actually ahead of curve in terms of what we had planned and targeted, and hence rebooting of the bank from our infrastructure capability, systems, processes, technology, people, and products will be complete, and our scale journey will begin starting FY27, and all of us are excited for that journey. With that, I hand it back for questions. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, wait for a moment while the question queue assembles. The first question is from the line of Bhavesh Kanani from S1 Investments. Please go ahead.
Thank you for the opportunity. This one is on the non-interest income. So essentially, last 4-5 quarters, we have seen NII remaining flat, and it is the non-interest income which is allowing us to do higher OpEx and still report growth at the bottom line. However, for some odd reason, the disclosures on non-interest income split has been discontinued in FY25 itself. So would appreciate if that is available to the public in general. That was one. And two, within that, if you can add some color on specifically the fees and commission line. While in past you have shared that large part of that is driven by insurance distribution income. Some color on the potential penetration that is still pending. Have we reached out, all the branches with ability and skill set to sell insurance, or there is still some room left which can be helpful in FY26 in terms of growing the fee income? And lastly was on liquidity. While excess liquidity has come off sequentially, one would have imagined little more reduction given that our loan book growth is quite healthy. Instead on the liability, we see that other liabilities have gone up sharply. So some color on that would be helpful.
Bhavesh, last question I didn't understand. What does it mean?
So, sir, essentially, when we met last time, the story was that we had amassed excess liquidity in Q4 given the situation back then, and now that liquidity situation has improved at system level, that would allow us opportunities to kind of normalize the excess liquidity, which will allow us to fund growth without really taking hit on the NIM. So, that reduction in excess liquidity is quite small. I think about 200 odd crores compared to a loan book which has sequentially grown by a larger extent. It appears to be the case where we have funded the loan growth by increasing liabilities, and that too is coming from not from borrowings or deposits, but there is a sharp increase in other liabilities, which has crossed some 2,000 crores odd. So I was just wondering what is leading to that increase, and incrementally your sense on to what level liquidity can be pared down without really disturbing the 5 or 6% kind of liquidity we have usually maintained.
Got it. I understood, Ravish. So let me try to respond to each of these questions. On the NII, which is non-interest income, And overall income, as you rightly said, that when we met, I had said already that as a bank, we are not very focused on non-interest income in this bank around 2-3 years back. And last 2 years, we have put conscious effort to put focus on non-interest income. It's just a matter of cycle that including non-interest income and overall income, the other part, which is the interest income, has not been growing very well, which is part of the cycle, because as we grow at such a rapid pace, there is some contraction of NIM, which you can see. And because, as I said before, that liquidity, given where it was in fourth quarter, we said that we'll not take any liquidity risk. And from that perspective, we did take excess fund, which ensured that we didn't know that time that liquidity situation will change in the ecosystem. So to that extent, we are carrying that cost through, and which is to some extent impacting on NIM to some extent. So that is correct estimate. Coming to non-interest income kind of a color, insurance income continued to do well. Generally, our PSLC income in the fourth quarter goes up a little bit, and then it normalizes first quarter onwards. Our core fee income, which is typically, if you look at it, if it's overall non-interest income is 19%, it generally varies between 17 to 19%. Last quarter was 21, last to last quarter means Q4. But generally it's somewhere around 17 to 19%. But core income is around 14 to 15%. We don't keep the PSLs in the core income. That's why you will see that this quarter our overall non-interest income has come down a little bit compared to Q4. Coming to a question that would we be sustainable, I think it is going to be more than sustainable, because once we have given the technology transformation news to you, you know that next year onwards we'll start scaling up our transaction banking business and our retail assets business, which are all fee-oriented businesses based on transactional fees and processing fees and many other fees. So that will grow. Insurance is a function of penetration into customers. And next year onwards, we'll start building our customer base significantly, because huge amount of focus will be on customer acquisition. And as more customer comes in, penetration on a larger base will be higher. So we will continue to do well in insurance business. And we are going to implement after this CMS, trade, and supply chain systems immediately after that. As we're talking, we are working on that, and all of that will help in transaction banking business, because we have built up a very good wholesale team and wholesale portfolio. So the transaction banking business will also add to fees. So I think as we grow the overall basic core book, our fee business will continue to grow, and there is no really one-off on that. We are sitting on a very large, given our size, fairly large AFS book, and we didn't max it out this quarter because we know that yields will come down eventually through the year. And from that perspective, you will continue to see non-interest income continuing to grow. On your second question, I've already answered on insurance, that we will continue to do well on insurance. We will see that. And on the liquidity question, I agree with you. What I said is also right. What you're saying, let me respond. If you look at our CD ratio this quarter, it has come to 91%, and generally it was around 83, 84% in that range, 84, 85, 86 in that range. One of the reasons, exactly what you're saying we have done, is we said that the liquidity risk in the system is lower, and hence we must start efficiently using the liability better, and that's why we said that, with the limited risk on the liquidity side, we will use it better. That's why the CD ratio has gone up a little bit, but we'll bring it down to somewhere between 85 to 90, but we'll somewhere in that place. Previously, my guidance was between 80 to 85. Now my guidance is between 85 to 90. In that range, we'll keep it at that size of a balance sheet and with the liquidity comfort which is there in the ecosystem. And I've always said that our liability franchise is not yet to that level where we want it to be, and that journey will start. We are waiting for the serious migration to happen. After this, the products will get implemented, and next year onwards, we'll see the liability franchise growing at a very rapid pace. That will not only help our liability book, more importantly, we will have more customers through whom we'll acquire and build the businesses. That's why we are starting to build our retail assets products and more retail liability products, current account products, trade products, all these things which are building, CMS, all these things we are building to build that franchise. Till that happens, we are, last year we did depend on FCY borrowings, we did depend on CDs, and to that extent, that support will require for another 1 or 2 years, while in parallel the liability franchise build, because you know that liability franchise takes 2 to 3 years to build. So that's broadly what may respond to your question, sir.
That's certainly helpful, sir. Repeating the same request that if the mix of non-interest income is disclosed like we used to do in FY24, that would only add to the wonderful plans that we have, and it will add to the confidence. And
sure, I'll check with our CFO on this. Okay.
And the last data keeping one was the other liabilities. Is there anything to look into that number, which is in sharp increase sequentially?
No, there is, we have.
The other liability, what we are talking about is the 2,600 crores that you see on 30th June, is a transitionary balance because the reconciliation happens with a 1 day lag, and then it gets adjusted with our balance with RBI. So it is not something which is a permanent nature. It is just a 1 day thing. When the reconciliation then happens, then it gets settled.
Okay. That's helpful. I'll hope you will share the disclosures on non-interest income on exchanges or on your website.
Okay. Thank you very much for your question, Bhavesh. Next.
Thank you. Best of luck.
Yeah. Thank you.
Thank you. The next question is from the line of Mona from Dolat Capital. Please go ahead.
Hi, sir. Good evening.
Hi, Mona.
Yeah. So firstly, I missed your opening remarks, so sorry if I'm repetitive. On the slippage bit, 139 crore, what would be the quantum of unsecured loans out of this, if any? This is CLCC MFI, yeah.
So I don't exactly remember that number, but broadly I can tell you that our unsecured book overall is around 3% of the overall book. So right. It won't be more than 20-25 crores. Satish is looking for that number, but it is there. But as a percentage, it is high. But the book itself is 3%, so it is not significant. But yes, it has increased. The 3 businesses, which is unsecured personal loan, the MFI, little bit of a credit cards, and Agri and MFI. These businesses had a little bit of a slippage, which is around, I think, somewhere close to, I was right, somewhere around 25 to 30 crores. Okay. So, our largest slippage, I think, to address your question, our largest slippage has been in SME this quarter a little bit. And that's primarily due to 3-4 accounts. And also, let me also say that what had happened this quarter is, because we are very busy on the migration, there was the data availability, because you know that to manage the NPA and to understand everything, we need data every day. Those data were taking little time for us to completely reconcile and get it. So by the time we got it, we didn't get enough time to manage the NPA well in SME business. As we talk, while SME business had a slightly larger slippage, but one account with 25 crores, we have already, not one account, but 1 or 2 accounts with 25 crores, we have already recovered as we are talking today. So, and there are 2 accounts which happened where there were some challenge, somebody, the owner died and something happened, etc., where the next generation is taking over the business. But all these are good news in SME is that all these are fully secured, and this will not really go bad at any point of time. So as the business starts going back, this does not worry me. So through the year, this should be able to recover. Otherwise, I think overall there is not much of any exceptional slippage in any other portfolio. This has happened only in 3-4 accounts where already a 25 crore has been upgraded. So that's the answer to the question.
So fair to say that out of this 139 crore, 25 crore got upgraded so far already.
Yes. Yes.
And also, just on the unsecured bit, is it partly led by FLDG cover against some of these assets, which is resulting in delayed recognition or something, if I'm reading it right?
Which one?
On the unsecured loans, which is, I guess, PL and some of the MFI portfolios are probably have some FLDG cover. And, is it the delayed recognition coming because there was some cover initially and now it's above that cover, which is why the recognition?
No. No, I don't think that is an issue. In general, what happens is FLDG is only in one business, which is in MFI. In no other business we have FLDG. But we have collection efficiency related incentives linked to that, so some cost will come down in case they cannot, but they're trying hard to get it right. But otherwise, if you look at it, we have been consistent in retail loans. If I look at it over the 5 quarters actually, June 24, September 24, December, March, and June 25. Every quarter is between 23 to 27 crores. Okay. So it's not that we have seen any major escalation happening suddenly. Also, Agri and MFI has also been more or less similar across the last 3 quarters. So there is absolutely no aberration in any other product. And if you look at it, our slippage in June 24 was 103 crores, and now it is 136 crores. Out of this 136, already 25 recovered. So to that extent, there is no exception in anything anywhere. Yes, we had 2-3 very strange situations in the SME portfolio, which are nothing to do with credit underwriting, which has nothing to do with trend, nothing to do with any industry situation. It is just pure, accidental kind of a situation where somebody died or something happened. So we are working with them, and these are all very well covered. So I'm not so worried about this slippage this quarter, frankly. But yes, on the retail loans, what goes, a lot of that will not come back. But that has been the story for the last 5 quarters.
Got it. And secondly, when I look at your cost of deposits, I understand a large part of it was bulk deposits. And given the sharp decline in rates on the bulk front, I believe the expectation was the cost of deposits to come down. And yet, seeing it rising, which is unlike what we're seeing for the rest of industry in general. So how do I read this? I mean, I was really surprised to see the cost of deposits rise during the quarter, because I would expect some of the bulk deposits to reprice at lower levels, right? And your deposit growth is declined. So, yeah, how do we read this?
No, so Mona, you are absolutely correct in your question. So you will see that playing out in our portfolio as well from Q2, Q3 onwards. So 2 things happened here on the deposits. One is that a lot of these bulk deposits and a lot of these businesses we did, because a lot of our assets business growth last quarter, because we are not growing at a 10%, we are growing at 31%. So a lot of this business growth, especially on the wholesale side, retail comes every day, gold loans comes every day, but wholesale SME comes a little bit rear-ended. So to fund that deposits, we had taken a lot of bulk deposits in the last end of the quarter, which was in March. And by that time, there was no clarity about the liquidity positions, what the RBI was looking at. So given that cost in that quarter came only for 10 days, 15 days, 20 days maximum. That cost has taken us through the whole of quarter over the 90 days. And that partially has done, we have got a 6 basis point increase in cost of funds. That primarily has contributed to this. The other thing which has happened is, I was analyzing this, that a lot of older deposits, because once we knew that interest rates are going to fall, we stopped taking long-term deposits like 3 years, 4 years, 5 years, etc. But we had some deposits which are old, which started, maturing, and hence got repriced, even if it is a lower rate, and started repricing at a higher rate than what they were initially booked, their contracted rate few years back. Okay, so these 2 events happened. Having said that, I think but if we had a parameter by which we could show you that how our contracted rates for the last quarter incrementally are, okay, either it on CDs or it is on bulk deposits, you are absolutely right. We are doing better off. What it means is Q2, Q3 onwards, we'll start seeing a drop in our deposit costs.
Okay. And also, if you could share what would be the expectation from a full year perspective on NIM, fees, and ROA?
Can you speak a little louder, Mona? Sorry, I can't hear you.
Yeah, sorry. If you could share your outlook on the NIM and ROA for this fiscal.
Yeah. So for us, typically what happens is, let me take the ROA point first. If you look at it, year on year, our ROA has come down from 1.27 to 1.03. But on a quarter-on-quarter, it has come down significantly more. And that is how it will play out this year also, because our ROA keeps increasing every quarter and it culminates at a much higher level in the end of the year. For example, last year in Q1 we were 1.27% and we ended the year with 1.79%. So this year also, I think on an average we should be somewhere around 1.5. That was my guidance, and we will retain there. On the NIM, we have surely bottomed out now, so we will be between 3.5 to 4. What gives me this confidence? I'll tell you. I'll give a logic to this. Is our cost of funds will start coming down because, as you rightly said, bulk and CD rates are coming down, and our bulk is around more than 35-40%. So from that perspective, it will in a way help us because retail will not come down that much compared to bulk. So we think that our cost of funds will start showing better trends. The other thing what will happen is also, okay, on your previous question, I want to also say that we tactically moved out some of the current accounts out of our base because we said that we want to build a proper current account franchise based on transaction banking, etc. So that also increased our cost of funds a little bit. Now through transaction banking, wholesale and other businesses, we'll start building the current account. That will also give us a little better cost of funds. And thirdly, because our EBLR portfolio is around 20%, around EBLR plus T-bill portfolio is around 17%, and our MCLR is only thing which is around 20%, which will reprice through the year, reprice downwards through the year. Our fixed book is around 60%, and hence we will have dual advantage on that front, that yields will not come down sharply and our cost of funds will come down a little well. Given that, I'm very, very confident that we will be in the range of 3.5 to 4%.
Okay. Sorry, how much was the EBLR that you mentioned?
EBLR is around EBLR plus T-bill linked, which from a cost of funds interest cost is similar. Sorry, interest expense is similar. When it comes down, the interest rate comes down. It is around 17%.
And just one question. So if I look at your, fee lines, the core fee lines ex of the treasury gains, are there any one-offs in the last fiscal, not this quarter, but in the last fiscal in terms of syndication income or something? Because it looks like fee to assets is settling at lower level. Yeah.
Yes. So yes, we had 3 syndications done so far. We have got a very good wholesale team now, and very good quality wholesale businesses started coming into the bank, and that is shown with the kind of growth which you have got both on the corporate banking and the and the mid-market side this year. In a year when we actually almost ran up 1,000 crores of DA portfolio, okay, which represented the wholesale part of the bank for whatever structural reasons we had put. So that team did put 3 syndication, 1 more syndication as we are talking we are doing. So we are doing those kind of deals, yes, where because given our size of our balance sheet, we cannot take a 500 crore exposure, right? So we don't take more than 150 or 100 or whatever, and rest we sell down and some of the sales down happening to larger banks as well, top 3 banks and top 4 banks, etc. So yes, we had some syndication fees last year. Also, as you know, that we have got we are net sellers in PSLC market, and a lot of that stuff we do in the last quarter of the year, and that's one of the reasons our ROA and our fee income is significantly higher in the Q4.
Got that. Just one last clarification. So what would be the income from these 3 syndication deals for last fiscal?
That we can share. That is too much details. But yes, I shared as much as I could. We have done 3 syndication deals. We are working on the 4th one.
Got it. Okay. Thanks so much and all the best.
Thank you, Mona. Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Yash Dantwaria from Dante Capital. Please go ahead.
Yeah. Hi, sir. So my first question is regarding the NIM guidance that you just gave. Don't you think your guidance is very wide?
Very what?
Very wide. The guidance is very wide.
Yes, I can only tell you that we live in a world today where we don't know what happens after 21 days. Okay. So, in that kind of a scenario, with global turmoil and global uncertainties, it's better to be safe than sorry later. So it is wide. If you want me to be more sharper, I will say that we will be somewhere in between of that curve, but it will vary from quarter to quarter. So if you take for the full year, I am hopeful that we should be somewhere in between of that, which is somewhere around 3.7.
Sir, can you please tell me if you factored in a rate cut in this? If you have, what kind of rate cut have you factored in with the NIM guidance, the current NIM guidance?
See, I'm not an economist, so I cannot factor in a rate cut, but people are saying, I'm reading that given where the inflation is, normalize it for the base effect, okay? And given that there are enough global uncertainty which we don't know which way it will play out, everybody says that there is a reasonable chance of one rate cut somewhere around between September to November. So if that plays out, we have factored that in because we are lucky that our EBLR linked and T-bill linked portfolio is only 17%. So that rate cut, even if it happens, to impact it on MCLR will go to next year. Okay? Next financial year.
I'm assuming you factored in 50 basis points, right?
25 basis points.
25. Okay.
25 more, I'm saying. 25 more.
Yeah. So, my next question is regarding your loan book, sort of, by the end of this year, how do you think the mix is going to look? Between gold loan, between all the sort of gold loan, LAP, etc., SME, secured, unsecured. Could you just give some guidance on how you're kind of envisioning the loan book to look like by the end of this year?
Yeah. So if you look at it, what has happened this year, what we have already reported is 1% it has gone up in the gold, and that has got from MFI and agri business. Okay. Because that is something which slowed down, and that, I mean, by that mixed percentage formula, it went to gold. What I see now onwards is wholesale will maybe go up by another 1% or 1.5% or 2% this year. So let's say wholesale is around 23 now. It may go up to 25. I don't see our MFI agri and retail going up that much. If at all, it will remain at this level. Maybe few basis points here and there, it can come down also. Because our real retail journey will start from next year. We won't take risk in this environment at this point of time. Our SME may go up by 50 odd basis points compared to where it is today. It is around 13% right now. So we should be seeing somewhere between 13 to 14%. And I think gold will continue to be where it is. I must mention here one thing, that our retail portfolio, what we show, also includes loan against securities, which has some gold loan. And that gold loan, based on the recent RBI circular, we may have to do differently, and hence we may have categorized differently, and hence that itself will bring down the retail again further, and that may come back to gold. So gold, for very different reasons, more technical reasons, it may go up a little bit. So in short, what it means is retail will come down further because of these technical reasons. LAS will come down. And LAS is typically around 2,000 crores right now for us, which is around 2,000 out of 35,000 crores is less right now. And that probably will come down significantly, and that may move some part of that to the gold, some part of that will move to the wholesale, and some part of that could move to the SME.
Right. Right. So my last question is regarding your sort of exit ROE and ROA. I know you guided for an exit ROA, but if you could just also guide for the exit ROE for this financial year.
So we will aim for, as I said, and this is consistent, I have been telling over the years, ROA 1.5 and ROE 15% is something which is like Lakshman Rekha for us. We have to achieve it, and we'll aim to do that.
Right. I'll come back in queue. I have a couple more questions. Thank you so much, sir.
Sure. Thanks, Yash.
Thank you. The next question is from the line of Shivaji Taprel from Yes Securities. Please go ahead.
Yes, thank you for the opportunity. So a few questions from me. So firstly, on asset quality, traditionally, our book was not so mature, and therefore it was not really throwing up slippages. Even now, the slippages are, compared with the broader banking universe, it's still under control, but nevertheless, some slippages are transpiring. So, where would we put the credit cost guidance for the full year, and where would we put it, on a steady state basis, say, from FY27 onwards? That's question one. Secondly, from an OPEX standpoint, you have been, making guidance in the past in terms of a glide path. Would like some reiteration or maybe some if there is any further color on how things are shaping up of late in that regard, and where the number might end up for the full year this year, and where we are probably going to head, from FY27 onwards. And thirdly, on the loan growth front, we have a small base, and I think growing 20% plus has never been a challenge in that sense. But nevertheless, what is the internal aspiration there from a 3-year perspective? If you could give us some color on that, those would be my 3 questions. Thank you.
Thanks, Shivaji, for your questions. So I'll go one by one. On the credit cost, general guidance always has been, I'm just repeating like a record, that our GNPA will be less than 1%, GNPA will be less than 2%, NNPA will be less than 1%, and credit cost will be less than 50 basis points. That has been our overall vision till FY 2030. We have been, of course, much lesser than that. Even this quarter, we are lesser. And our guidance for this year is GNPA, NNPA, and credit cost all will be lower than where we are in Q1. That's for sure. Okay. Unless, of course, we don't know the global uncertainty on the Trump tariff, what it comes. I'm just not taking that into consideration. If that happens, then we have to recalibrate. Second part of your question is on OPEX glide path. If you look at it carefully, our OPEX glide path is going down to 50% by 2030. We hold on to that because our real story will emerge from next year as our liability franchise starts building, along with that cross-sell on assets, fees, and transaction banking and wholesale and SME, all of it together. So the real orchestra will start playing out from only next year, and we'll start seeing results FY29 onwards. So I'm pretty much holding on to the glide path of 50% on OPEX side, cost to income side. And if you look at it, this quarter even, our YOY growth on operating expenses is only 12%. So we have been pretty conservative in terms of our operating expense at a time when we are massively investing into technology. So to that extent, we are very conscious of productivity and operating cost. The reason our cost to income has gone up slightly on a year-on-year basis, it has come down. On a quarter-on-quarter, it has gone up a little bit. It is, of course, because of the income and other income and everything has come down a little bit. So once the ROA starts going up back to 1.5%, this will itself come down to some extent. But the real glide path sharp glide path will be FY28 onwards, and we are pretty confident of reaching 50% by 2030. On the loan growth, on a 3-year basis, I think we'll have a reverse trajectory. With every year growing, our loan growth will only go up. Why? Because even now we can grow faster than what we are growing in loan, let me tell you. Our constraint is liability. And once our liability franchise starts building up, because based on bulk and based on cities and based on FCY and based on whatever little bit you are doing on the retail side, etc., you cannot have a sustainable growth on the asset side. Additionally, as the retail part of the franchise starts growing, also we are pretty clear that wholesale and SME also has to bring in liability because they have a safe funding target, especially on current accounts, especially on low-cost funds, etc. Once that starts playing out, we will be able to grow faster. And because multiple products will start playing out, like last year our wholesale started. SME has been going on for the last 2-3 years. Retail part of the story will start next year. So, and gold will continue to grow as it is growing. So given that, suddenly you are seeing, if you look at consistently, this year, SME, wholesale and retail, all three grew by 30% plus. And this has never happened to the bank. When I say retail, I include gold in that. So, 3 franchise, each of them growing 30% plus, shows that we have the sustainability and now we have caught the rhythm of building that business. Our constraint comes on the liability side, and we are fully focused on that. And once we build that, our credit growth, which is right now somewhere between 20 to 25, safely, and maybe above 25 also if our liability allows us, then next year onwards, as our liability franchise becomes better, we will do better growth on asset side. So we are pretty focused. We don't have a capital issue. We have enough. Our CRAR is on the higher side. So from all aspects, growth is not a problem for us.
Thank you.
Thank you, Shivaji.
Thank you. The next question is from the line of Rishikesh B. an individual investor. Please go ahead.
I think most of my questions have been answered. Thanks for the opportunity, though. Just wanted to ask regarding the ROA guidance. Previously, it was like in the range of 1.5 to 1.8% for the entire FY26. But right now, you just mentioned that you will be touching around 1.5%. So, are we like having 1.5%? I mean, essentially reducing the guidance, is it?
Thanks, Rishikesh, for your question. So what I said was 1.5% ROA and 15% ROE is our Lakshman Rekha. So we cannot go beyond that. But if we have that opportunity, we will do higher than that. Having said that, we all know the environment we are in today. Not only us, if you look at the entire ecosystem, there are challenges in the ecosystem, and there are known unknown challenges and unknown known challenges right now, which are mostly coming from global uncertainty. Given that, I think we'll be happy to be around 1.5% this year. But our guidance on 1.5 to 1.8 is for our SBS 2030 journey. I'm 100% confident that we will achieve that vision of 1.5 to 1.8, and maybe we'll be closer to 1.8 as our retail assets and other franchises starts picking up, and our overall cost of funds cost to income starts coming down, and we leverage the branches and our franchise better. So our guidance of 1.5, 1.8 in past also is over SBS 2030, which is again the glide path or whatever, rise path, whichever way we look at it. But this year, given the overall global uncertainty, 1.5 is something which we should achieve, and we'll be happy about it.
All right. Thank you so much.
Thank you, Shivesh.
Thank you. The next question is from the line of Yash from Dante Capital. Please go ahead.
Hello.
Hi, Yash.
Hi, sir. So my question is mainly regarding your gold loan yields. How do you see your gold loan yields moving from here?
So our gold loan yields typically has been between 11.5 to 12%, depending on which products we're looking at it. Because of the regulatory guidelines now that has come, which is now very clear. It's no longer draft, no longer any guesswork. It's very clear, black and white. We know what business we can do, what business we cannot do. And hence, I think our higher yielding businesses will grow a little more. Because the loan against securities business, which was more deep ledger kind of a businesses, that comes slightly at a lower yield. So from that perspective, I think we should not see a fall in yield in our gold loan. I think we should be somewhere around to 11.8 in that range we'll target.
Yeah, and so my last question is regarding your cost of funds. What kind of exit in cost of funds do we see by Q4? How do we see this number? You said it's going to come down, but do you have an estimate that you can share?
Very difficult, boss. The way situations are evolving. One day the yields are 6.2, 6.3. One day it is 6.5, 6.6. So how do I know which way it is going? But broadly, the way we are looking at it, I think from the current level, our 20 basis points drop is minimum which we can aim for, in my view.
Right. And as far as this technology platform and whatever you've been working on in the last, maybe I think around 2 years, if I'm not mistaken, what is this going to kind of help us the most in? And what percentage of our collections are online today without the help of physical collections, basically?
I'll answer the second question first. Our CIO is sitting here. I'll invite him to give you some broad perspective of what we have done and what we plan to do and how it will help, because he and his team has worked very hard. So let him also talk to on this call on what we have achieved. But on this collections thing, I can tell you is that while I understand the digital collections and all that, of course we are invested into that. We are into telecalling collections, all of that together. But our overall retail book is very small, okay, which requires all this straight through process collections and all that. That is very small today. We are building that capability, but that opportunity itself is small. And given on the credit card side, because we don't have our own credit card product, we do it through Jupiter and all that. They have their collection setup, which they do, which has all online and everything, and offline, of course. You cannot do recovery on online. So given that, we are preparing for ourselves, but we don't have that portfolio size to test that as much, but we are building that. SME and wholesale and those kind of businesses, you need mostly legal, technical, all those kind of things to collect. And that's where our legal teams are very strong. And our primarily recovery and collection on the SME and wholesale side is handled on our offline mode and on man-to-man collection. So that's the way it works. On the technology, I'll just say one line and then I'll hand it over to Rajesh. It will help everybody, okay? Because we must understand that we are coming off a legacy system where you cannot add one more product, then the system doesn't work, okay? What we had in Marvel. Premium liability product I tried to introduce, it could not be introduced properly, okay? We didn't have transaction banking products. We didn't have CMS. We didn't have trade. We didn't have supply chain, okay? Our mobile banking, net banking was functional. But on our OBDX, we are moving at a very different level, okay? Our entire digital ecosystem, our ServiceNow platform, everything what we are doing is very differently. Our data centers today are having 2 data centers along with 2 NDR, which are most sophisticated and the best places. We are on a 11G on Oracle platform on the database. Now we are on 19C, which is the latest. 11G is not even supported. So that kind of a transformation we are doing. And it will help every business. On the wholesale side, it will help to the transaction banking. On treasury side also, it will help the transaction banking and some of the other systems they are implementing. but it will maximum help in retail acquisition of new customers, STP, onboarding, creating various services, various products. Because why should a customer come to me if I'm not able to give personalized STP, different kind of services with a good onboarding system and processes? We have created ecosystem around it through our VRM, which is virtual relationship management. All those systems are ready. We have contact centers. We have created everything. We are just waiting for this connectivity to happen through the technology. Once SME, it will help in a big way. We are going to launch our new corporate net banking in the next 6 to 9 months, which will help us in a big way, both SME and corporate banking. And of course, retail assets, LMS, LOS, all of that stuff was not in the bank before actually. I mean, how could you run a retail assets business without these products, without these systems? So all of these are now going to be functional. So given that, it will help retail the maximum in my view. And gold loan is a functional business. It is most touch and feel. Systems and better efficiency does help. We are also working on a Neo for our acquisition platform, and which is digital. I think we are going to make significant investment there to upgrade it, because our main focus will be on customer acquisition and the retail, because liability franchise has to be built up. We are going to launch various current account products now that we'll have those systems and processes, and once we have the corporate net banking in place, it will be a different league altogether what kind of current account we'll do. So that's a flavor on what we are planning to do on the business side. Okay. But just I'm requesting Rajesh Chaudhary, who's our CIO, who has led this entire tech transformation for the bank, to give a 5-minute snippet on what we have done and what we plan to do and how it will help the bank. Over to you, Rajesh.
Sure. Yeah. Thank you, Pralay. I think you covered quite a lot, but I think in quick summary, what we have done is we have overall the entire technology ecosystem in the bank, setting up 4 data centers, building new core banking, which just went live in the month of May, along with 50 plus different surround systems. It has been a massive transformation, and that's what all the partners who have been working with us, they tell us that they haven't seen something of this kind. Of course, there are a lot of core banking transformation which keeps happening, but so many systems going live together is something very unique. So at this point of time, we have got systems in place for the business. So like we are now ready to create products and build capability for doing business for all the respective business lines. We have also built capability to do the right compliance and the right regulatory work. So there is a significant amount of regulation what we have to deal with. Cyber security, information security, we have to ensure that the entire ecosystem is safe for our customers, for our employees, and for the banking industry as a whole. So we have put all the elements in place. And with respect to channels, with respect to payments, everything is overall. So we have got everything brand new, and we are ready to deliver it to our customers. And we will keep optimizing this. We will keep investing further. But the major overall has been done, and we are all geared up to do more and more business on this.
Well, you're talking on the regulatory framework. We have implemented a new FRM system.
Absolutely.
We have implemented a new compliance system.
Yes.
So almost everything is fresh and rebooted the bank from a technology perspective. Yash.
Yes. So one last question before we drop off. Could you just give me the secured versus unsecured breakup of the book currently?
So unsecured can be seen in 2 ways. Retail unsecured is only 3% of the overall bank's book. But then when you look at secured, some of the unsecured businesses are the best secured business. If you do business in Tata, if you do business in Jindal, which you have done, by the way, okay, they are more secured than secured businesses actually. So if I give you that ratio, that may not be the right representation. What we call
the retail one is more convenient.
Retail one is 3%, and SME we almost never do unsecured business. So that's broadly what it is.
So out of the entire, you said you've recovered 25 odd crore. and you think you're going to recover more, right? So,
But that will
SME,
take
what
time.
was...
That will happen through the year. The rest will happen through the year because the business is to be restructured. But the point is, they're all secured businesses. They're well collateralized. So this money will not go anywhere. But we obviously, SME, how you run the business is you don't immediately call back the loan and say that give me the money or I'll sell your property. You have to help them in rebuilding the business.
Of
That's
course.
what you are doing. But these are recoverable. That's the point I'm making.
Thank you. Thank you so much for taking all my questions so patiently. Have a great day.
Thank you. Thank you very much. Thank you, Yash.
Thank you.
Thank you. Ladies and gentlemen, as that was the last question for the day, I will now hand the conference over to the management for the closing comments. Over to you, sir.
Thank you very much. We had a wonderful conversation, and thanks for patiently listening to us. Look forward to our next quarter analyst call again. Thank you very much. Have a wonderful evening.
Thank you. On behalf of Yes Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.